Hello folks, this is Brandon Chapman with you today. It's another video for TheoTrade. It's October 13th. We're about 10 minutes before the close, and the S&P appears to be looking to close higher by about 1.5%. What does that exactly mean for the broader market? Well, you know what? Look, you sell off like we saw on Friday. This creates one of those scenarios where you typically get a bounce. Well, what am I talking about? You look at the VIX, for example. The VIX saw a significant spike. And I usually will quantify by looking at the Keltner channel 2 ATR 20-day. And look, we close outside of that. That's a big deal. That's typically gives you an indication, hey, we might be capitulating in the very short term. The S&P was down greater than 1 ATR on Friday. In fact, you can see here we're towards the high end. There's two ATR difference here. We were down close to 4 ATR yesterday. That's 4 times the average true range. The range from high to low, or from the previous day's close to the next day's high and low. We were primed for a bounce today, and we're getting it. But if we look at our watch list over here for the sectors, for example, and we look at what's leading, gold's leading out 2.4%. Yes, technology is up 2.4% as well. But look at this. Let's bring up ARK, the innovation fund. ARK's up about 1.5%. We're not exactly seeing tremendous leadership off the lows. We're barely outperforming gold, which just says the dollar's down today, helping to buoy the market. Well, look, we just came off a pretty volatile day on Friday, which, by the way, if you're a first mover Market Advantage newsletter subscriber or Ghost Sprints member, you knew about this big trade that occurred in the SPY, a downside hedge that occurred just before the sell-off on Thursday, and we saw this big sell-off from Friday. It was on the SPY, totaling about 400,000 contracts, a downside put hedge. Again, these hedges are big, and they signal something very specific. The risks are inherent in the market at that point in time. Well, we circle back to gold today at 2.4%. Well, what about silver? Silver is up nearly 4% today. Well, if we look at silver, for example, on Friday, it didn't really generate any sort of volatility. We opened and closed at about the same price. We were down slightly from the previous day. Up slightly from the previous day. The previous day, this is Thursday the 9th, we experienced significantly more volatility. Well, why did we get it on Thursday and not on Friday? Well, there is a very specific risk to silver right now. When we talk about precious metals, there is a paper market for the precious metal, and there's an actual physical market. The reality in the paper market, such as silver futures, for example, /SI, the paper market for silver applies leverage because you only have to put up a certain amount of money in margin in order to go long a silver futures contract. And so what we saw on Thursday was that the CME increased the margin requirements for it to hold a silver contract. Well, look, we shrugged it off by the end of the day. Friday produced no real risk. Today, we're back at it at the higher margin level. What causes them to raise the margin requirements? It's because of volatility. And is today a departure from volatility? Well, look at the range from high to low today. This is a very significant move in silver. Is the CME about to raise the margin requirement further limiting the ability to leverage your trade? And all it takes is a bit of a reversal, and all of a sudden, those that are leveraged get wriggled out of the trades, and they sell at market. This creates substantial volatility in silver right now. You back it out to prior times where you've seen major moves. For example, go back here, for example, to April of 2025. These reversals can be very, very harsh and significant. Silver is a much more volatile trade than gold is. Silver is more of an industrial metal. Gold's more of a precious metal, right? In terms of money. And so right now we are seeing a weaker dollar certainly prop up precious metals prices, and silver among those. But we also have the backdrop of a weakening economy. But this is about speculation. It's not about the fundamentals. And in fact, if we go to /GC plus /SI, we'll take a ratio of gold and silver. So I'll bring up the pairs ratio study in here. What you'll see is that we're back down to the same level we were in the gold to silver ratio in terms of futures that we were about the same time last year. which just shows that since April, silver significantly outperformed gold as we've basically tried to play catch up, closing that gap that was formed in the selling of April. What this points to is that, look, if the market were to correct like we saw in March and April, we'd probably see this silver to gold ratio likely go up, and that may occur as gold and silver are declining, at least initially for gold. And so as we look at silver right now, we recognize that, look, there's a significant speculation in the market for silver at the moment. And the downside risks are substantial if we start to see margin being raised and we start to see the very speculative weak hands that are holding the silver positions right now. We could see selling a market like we saw temporarily on Thursday. And if we see any follow through to that, we could see a pretty significant correction. And as I have my Fibonacci's drawn here, this is blown through the 423. This is a substantial move in silver. It cannot be underestimated in terms of how much we moved in such a very short period of time. As I draw my fibs here, you'll see that if we get a correction, would it be unreasonable to see 40 on SLV, 36 or 37 or 34.50? These are typical retracements given the uptrend we've already experienced. A move to 34 would mean what? About almost a 30% decline in the value of silver. Would that be unusual? No, given the massive moves we're seeing right now. So what are we seeing on the institutional side that might suggest that, hey, we're kind of getting a little sketchy up here? Well, we're going to go to the Ghost Prince console, and I'm going to show you something that is that the console brought up today. And you might be asking, what's the console? This is something that I developed to identify significant option trades. And what you'll see is silver, and I have the location set here, and we're looking at put sides. You'll see 18,000 contracts traded today, and all of that virtually in one trade at the ask for October 20 expiration 46.50 strike. So that's a very significant trade in silver today. And look, there's some call trades as well, but the call trade is pretty well known, right? It is very crowded to the upside up here. The risks to the downside are significant. And yeah, we might have a chance of grinding it out here. And you can buy call spreads and put spreads and do it pretty cheaply. Why? Well, if we scroll in here, you'll notice the volatility is rising on the call side. Volatility is rising on the put side. Well, actually kind of falling and then started to pick up a little bit out here. I was looking at a little bit shorter expiration, but it's pretty flat. I was looking at this early today, and this was actually a little more beneficial to the downside of the put spread. It's decently flat once you get out to a 40 delta here. But this was a little bit better priced about an hour ago. But as the call side, again, you can buy lower call strike price, sell higher strike price, and get pretty dang good pricing to be able to play the upside. And it's not terrible to the downside around that 40 delta area to buy here and sell there, even though it has shifted a little bit. That's the bell for the close right now. So what we're seeing is that, look, I mean, there was a significant trade today, and you'll see it right there, 18,500 contracts. That was bought in one print. That's over a $2 million trade. And again, I don't have to search for it anywhere on the platform here because why? Because we have it right here. It's easy to see and call out. It takes you literally minutes, which would otherwise take you hours to do on the scan tab on Thinkorswim. And then it's a matter of whether you have enough time to actually dig out this trade. You're doing it easily in minutes on the Ghost Prince surveillance console. Now, here's the deal though. What does this tell us? You might say, well, is this a hedge? Probably. But does a hedge invalidate it? No, it doesn't, right? Mechanically, it creates the same dynamic. If we have a lot of pressure here at 46.50, we go to and through 46.50, it creates additional downside. But the timing does tell us something. The timing tells us that right now, they are putting on a significant hedge. They didn't do it yesterday or even Thursday, but Thursday's volatility as a result of the margin increase requiring more capital to carry a long futures contract in SLV just tells you that, look, it's not misplaced here. And what we saw on Friday in terms of the volatility of the overall market and that significant hedge that was put on Thursday, 400,000 contracts, again, telling us that, look, this is the time to be wary. It's the time to hedge. And to be honest, it's not that hard necessarily to take a downside shot in the next 39 days. For example, let's come back up here. Could we get a 46.44 for less than a 80-cent debit? So I'm going to go 4-strike vertical here. Like you can, it's about 98 cents here. So the skew is working against it. But what can you do alternatively? Now I'm remembering what I did. Let's go to HELA, right? HELA, for example, this is a stock. You can see on Thursday, the gap and fade here. We're down on Friday, up here today, testing resistance. Well, if we come in here, notice that the volatility skew, as we get a little bit out of the money, it starts to pick up here. The spread kind of widened out here. Sorry, the market just closed here, but could you buy 13 and sell 11? Can we get it for less than like 80 cents? Let's try it. So we'll go 13, we'll go 11. There's still premium out there to sell at 11, right? Over almost 40, 50 cents. Goes about 64 cents. This is what I was looking at earlier at HELA. So it might be more difficult to trade silver to the downside. Maybe you could buy a put, but you could trade silver equity like HELA, for example, and the pricing's much more favorable for playing a downside spread. And guess what? Stocks have more risk than silver does. So what are we looking for in something like HELA? Well, we just need to move down towards 12, maybe to move towards 11. This could create a significant upside. You can see, okay, I'm looking for 70% return on that 64. You probably get it if we can pull back to 12. We're not expecting silver to crash here. All we're looking is to see some volatility be realized to the downside. Because right now, silver's overbought, very extended, both in its ratio against gold and in its near-term price appreciation. And the timing of today's large hedge in silver says, look, you might want to moderate some of your expectations. You could even take a little bit of a downside trade in something like HELA or silver and just look for a little retracement off our highs. And again, maybe it turns into a bigger one to boot. So again, lots of opportunity to play the downside. And frankly, the upside still in silver, but today's trade certainly represents the downside risks in silver, which creates opportunity if you take the bearish end of it. Well, folks, that's all we got for today. Catch you back next Monday. Have a great one. Thank you.